equity has the potential to create wealth over the long term. However, one has to survive the high ups and downs that come along with the market to earn these returns. On the other hand, debt generally provides some amount of predictability in returns, with lower ups and downs. Thus, with debt, one could get moderate returns. For the possibility of getting good returns and lower volatility, it is important to have a mix of equity and debt in your portfolio. But what is the right balance of equity and debt? Thankfully, these exact questions are addressed by Dynamic Asset Allocation Funds. As the name suggests, these funds dynamically allocate money to equity and debt based on a preset model that assesses and analyzes market conditions. When the market offers favorable equity valuations, which shall likely bring good returns for the investor, the fund automatically starts investing more in equities. When equity valuations are expensive, the fund reduces equity allocation and increases its debt allocation. Classic buy low, sell high. Dynamic Asset Allocation Funds make these allocations based on fundamental valuation indicators such as price to earnings ratio, price to book, etc., and technical indicators such as historical moving averages. For an investor to keep track of market movements and accordingly rebalance their portfolio manually can get overwhelmingly stressful. An investor can also get swayed by their emotions. However, dynamic asset allocation funds are immune to emotions in the market. They act solely based on rules and formulas that automatically balance the debt and equity allocations for the fund. Dynamic asset allocation funds can be compared to driving an automatic car. When driving on an empty road at full speed, the car shifts to the highest gear automatically. Dynamic asset allocation funds automatically shift more funds towards equity when they see that the market has more upswing potential. When we reduce the speed due to traffic, the car automatically shifts to second or first gear. When market valuations are high, the fund reduces equity allocation and increases its debt allocation. When the road is clear again, the car will automatically shift to fifth or sixth gear. When the market valuations are favorable again, the fund automatically starts investing more in equities. The allocation between equity and debt in these funds depend on the valuations of the broader market. This constant rebalancing of the dynamic asset allocation funds aims to reduce volatility in comparison to the broader stock market, ultimately giving the investor a better experience with lower ups and downs. An investor can invest at any point in time in dynamic asset allocation funds without worrying about the market conditions, thus making it a favorable choice for investors who aim to create wealth with lower volatility. Dynamic asset allocation funds can be structured in a way to enjoy favorable equity taxation. Let us recap the benefits of investing in dynamic asset allocation funds. The fund tries to create wealth with a combination of both equity and debt. The fund rebalances automatically between equity and debt based on market valuations. The fund makes its allocations using well-calibrated financial formulas and does not consider investor emotions or market sentiments. It's an all-weather fund that has the potential to do well in all economic scenarios. More importantly, the potential of low volatility makes it a favorable choice for investors comfortable with moderate risk. Speak to your mutual fund distributor to learn more about dynamic asset allocation funds and how they can help smoothen your investment journey to accumulating wealth. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.